Hello guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. When then are we producing as possible bonds as early as the coming week? When broad sentiment is highly bearish, it increases the likelihood that whoever wants to sell has already done so, leaving demand is charged. Technicals are helping confirm this. The S&P 500 answered the minimum monthly target of its H&S top, and the index dropped 5% and 70% in the previous weeks, especially. The benchmark is also 7% above its 200-week MA, which means there is still room for another similar weekly decline. Not to that significant support such as the often reaches by its strict location as trades try to beat each other to the punch. There could therefore be another weekly decline before a likely rebound if we don't experience a short-term bounce this week. Significantly, the decline of all 11 S&P 500 sectors simultaneously during the past week demonstrates the aggressive nature of the fall, which also primes the index for a rebound, as well as on a weekly basis. All 11 sectors are lower over the previous month and the past 3 months. The single bright spot is the energy sector, which has been up over the previous 6 months. The remaining 10 sectors are deeply in the red, with utilities and consumer staples down the list, and consumer discretionary, communication, service, and technology shares taking the brunt of the sell-off. The yearly view it shows the 6-month view. The S&P 500's entry into a bear market means it joined to other major U.S. indices already in Islam. The tech-heavy Nasdaq 100 and the small cap Rules 200 down respectively. Similar to the S&P 500 more recently, the NNDX reset the implied target of its H&S top and is about 4% above its 200 WMA after coming within 2% of this weekly average during Friday's session low. The Nasdaq 100 joined on Friday after having dropped 34% from its November 22 time high on Thursday, its weakest level since September 24. The Dow Jones Industrial Average as the only major benchmark that hasn't yet shown a reversal pattern since its downturn began. The 30 component blue chip index may yet show more weakness as there appears to be no demand on the technical chart to offset supply in order to create a range. As well, the Dow weakened even further when the index fell below its falling channel on Friday, suggesting a steeper discount ahead. However, the DJIA and the only major US index not yet in a bear market, so it's just a wish far away from that designation. On Friday, the index fell as much as 19% intraday from its January 5 all-time hike, dropping to its lowest point since December 1, 2020. The price rose 1% from the 200 WMA and closed 2% above it. The second worst performing major US index after the Nasdaq 1%, and 100 is the Russell 2000. While technology stocks have been sold off as more expensive money if interest rate hikes make their total valuation too expensive, small cap domestic companies are at a disadvantage to multinational, which have the stronger possibility of continuing to grow profit despite rising interest rates. Of as Thursday low, the small cap judge registered loss from its November 8 all-time high, erasing all gains since November 2020. The Rules 2000 is the only index that has already fallen below its 200 WMA. Its dropped down and dropped right target. The current FADQT cycle preserves technology and small cap shares equally. This positive correction was visible Friday when both the Nasdaq 100 and the Russell 200 joined, along with the fact that technically stocks are poised to continue lower over the long term. Within their downturn, and Federal Reserve has indicated there will be continued tightening ahead. Indeed, this past Wednesday, the U.S. Central Bank hiked rates by the most significant increase since turn 1994. Bottom line, many these days investors have never had to operate within a tightening economy, and a significant number have been spoiled by QE when lower or even steady rates ultimately turned into what seemed like an unending equity debt buying opportunity. Currently, that's already changing. 30 years, including for the 10-year benchmark, also pushed higher, touching their biggest level since 2010 with make rates on Federal close well of the weekly hike but at highest level since 2018. Maybe that's all for me. Don't forget to like, comment, share, and subscribe. Thanks.